Trading slippage is our common enemy that erodes our strategy's expectancy and usually becomes much more severe after going live. I'll explain why slippage occurs, how you can minimize it, and how you can realistically simulate it in your backtests.
Slippage is the difference between the expected price of a trade and the actual price at which the trade is executed. Let's say you place a market order to buy at $100, but you actually get filled at $101. Or you are long with a stop loss at $100, but you got closed out at $99. In both cases, you have experienced a $1 slippage. In general, there are two causes of slippage. The first is execution delay. There's a small delay between the time your order is placed and the time it's executed by the server. Even if it's only a fraction of a second, the market price may have changed or the spread may have widened. The second cause is low liquidity, whereby there are insufficient buyers or sellers at your requested price. Suppose you place a market order to buy 2 lots at $100. This will be executed at the lowest price offered by sellers. If there are many lots on sale at $100, your order will be filled without slippage. Otherwise, your order will move up to the next available price. This will occur repeatedly until your order is completely filled. Eventually, you may have one lot filled at $101 and the other at $102, giving you a total slippage of $3. Unlike execution delay, slippage due to thin liquidity is far more difficult to simulate in testing. Sometimes you will just have to trade live with a small account. Slippage is especially detrimental if you trade frequently or have a small expectancy. Here are 4 tips to minimize slippage. Firstly, you can avoid trading during illiquid hours. The first hour after the New York close is typically the most illiquid period of the trading day. Your risk of slippage increases dramatically within this period. I previously measured the Pound Canadian spread over a 24-hour period. The drastic spread widening up to 20 pips shortly after New York's close illustrates the thin liquidity during this period. Preventing entries and exits in this window is a good way to minimize slippage. Some mean reversion strategies, like the so-called Asian scalpers, exploit the random noise during these illiquid market hours. Since slippage can have a large impact on performance, be wary of overly optimistic backtests. Secondly, you can avoid trading the news. In volatile, fast-moving markets, prices are likely to change during your order's execution delay. If your strategy trades through the news, or even trades off the news, some slippage is practically guaranteed. A good time to observe this is during the monthly US non-farm payrolls report. Central bank announcements aside, this has consistently been the mother of all US economic releases. The strong price action and tick volume indicate the vastly increased trading activity. To mitigate this, you can add a live news filter that pauses trading before high-impact news, or you can add a time entry filter that prevents trading in a certain time window, such as Friday mornings. Whichever option you choose, ensure that you can replicate similar filtering conditions in your backtest. Next, you can use limit orders. A limit order is only executed at the price you specify or better. A buy limit is placed below the current market price, while a sell limit is placed above the current market price. Unlike market orders and stop orders, limit orders won't fail at a worse price. Any market order that you can replace with a limit order will reduce slippage. In fact, you may even get positive slippage. Of course, this doesn't mean you should exclusively use limit orders in order to reduce slippage. When you need to exit the market in a hurry, for example when your stop loss is hit, the immediate execution of a market order will come in handy. Lastly, you can use a Forex Virtual Private Server or VPS. A VPS is a computer that you can access remotely and house your MT4 platforms on. The key is to select a VPS that is located close to your broker's servers. This will minimize latency and keep slippage low. The chart here shows the latency in milliseconds between FXVM's New York server and several prominent brokers. If you're a scalper and every pip is critical, renting a VPS is highly recommended. For a realistic backtest, all transaction costs, including slippage, need to be included. You don't want inflated performance metrics that cannot be replicated in live trading. In addition, when optimizing your strategy, excluding slippage usually creates a bias towards parameters that increase trading frequency. This creates a double whammy because the more you trade, the more you lose to slippage. So let's discuss several ways to include slippage in your backtests. First, you can add a constant slippage per trade. StrategyQuant's backtest engine lets you separately specify each type of transaction cost, including slippage. The 1 pip slippage specified here will be applied to every market order in your strategy. So, for example, if you enter the market on a buy stop and exit using a stop loss, the backtest engine will register a 2 pip slippage. If you instead enter on a limit order and exit on a profit target, you will not have any slippage. To demonstrate the effects of slippage, I will use a pound kiwi scalping strategy for the rest of this video. Here's how it backtests with a 2-pip spread and no slippage. After adding a constant slippage per trade, here's how the equity curves compare. Even a modest 2-pip slippage is enough to halve the strategy's profit. So how much slippage should you specify per trade? This depends on your strategy and market. Here are some factors to think about. Are you trading thin markets like emerging market currencies? Are you mainly using market orders? Do you often trade during periods of high volatility or low liquidity? You can refer to the Analysis tab to find out your strategy's typical trading days and hours. If many of the above apply to you, a larger slippage is warranted. It's better to be conservative during your development than to be disappointed during live trading. If you use MT4 for backtesting, you won't be able to directly specify slippage. You can increase your spread to reflect higher transaction costs, but you won't be able to specifically target your strategy's market orders.
Another approach is to randomize slippage using Monte Carlo simulations.
Monte Carlo simulations use repeated random sampling to provide a probabilistic assessment of strategy performance. For the purpose of slippage simulation, let's run 1000 separate backtest runs, each using a random slippage within the 0.5 to 3 pip range. I will set up StrategyQuant's Monte Carlo simulator as shown. Here is the collection of simulated equity curves. The original equity curve, which has 0 slippage, is outlined in blue. Since all 1000 simulations have slippage applied, they perform poorer than the original. There is still a $5,700 profit at a 95% confidence level. This means that of the 1000 simulations, only 50 produce a profit worse than $5,700. This is an acceptable result to me. Once again, the strictness of your passing criteria will depend on your strategy and market. Minimizing slippage using the tips above and subsequently including slippage in your backtests will help avoid unpleasant surprises while trading live. If you want to fast-track your development with StrategyQuant, be sure to use the discount code in the description. Please support the channel by subscribing and stay tuned for more tips.